Is this a market, an equity market, that needs a cut from the Fed?
Good morning, Tom. I think we are seeing interest rate calibrations now, settle in again into markets. I think markets do need to see an interest rate cut. We're seeing, based on the data last week, bad news is again being viewed through a lens of good news because we're likely, given the slightly bad economic data that we had coming out via retail sales and a slightly hotter CPI print, that's being viewed from the lens of, giving way to the possibility of an interest rate cut by the Fed. And I think it's quite important because we are seeing overall earnings improve in the U.S., but it seems like quite a split market where we're essentially seeing the Magnificent Seven leading on the earnings front, whereas the rest of the market lagging in a way. And so this interest rate cut would be quite beneficial for equities going forward, especially given the fact that we started the year with such a strong, expectation of more than 7 cuts. It then got dialed down to virtually none. And now we're seeing 2 interest rate cuts being brought back onto the table.
Yeah, it's from 7 to just shy of 2. Market's pricing at about 40 basis points or so currently, with the first one locked in for November. Aneeka, with the dot plot revisions that come through in the next week or so from the Fed, if we go from 2 to 1, is there a sensitivity, is there vulnerability across the stock market, and which parts of the equity space would be vulnerable from a move from 2 to 1?
Yeah, I think it's going to be the cyclical parts of the market that will be most sensitive. Most of the technology names, the growth-oriented stocks would get impacted if we see it. If we see those interest rate expectations revised again, because there's been tremendous amount of interest rate volatility. So to see that being revised again would, imply higher yields, and those higher yields are going to, press on and put under pressure those longer duration equity set parts of the market.
Mm. What are you seeing in terms of that valuation gap between Europe and the US? Does that converge further? Is that supportive for European equities in the quarters ahead?
Absolutely. We're at a point where European equities have outperformed the US. We are seeing that legacy valuation gap now begin to converge. Since 2008, the financial crisis, we've seen U.S. equities really outperform European equities. This has been a remarkable year where Europe has done much better. And this is really on the back of a better economic footing. We've seen improving economic data in Europe coming through. We're also seeing, the expectation of interest rate cuts, the interest rate cut cycle beginning in June and taking fruition by the ECB. Alongside that, we're seeing a better earnings distribution. So now we're seeing European companies increase their share of buybacks, and that is, again, enhancing returns for investors in Europe. And I think more importantly, this valuation gap, not just between the US and Europe, but other countries geographically, even if you bring in Japan into the mix, we are seeing investors globally now want to diversify their exposure, and hence it is benefiting other geographies such as China, Europe, as well as Japan, and we've seen that play out in 2024.
OK, so that diversification theme. I wonder if the Nvidia earnings that drop on Wednesday are going to change that, and it all just gravitates back to the US if they come through with a strong beat. How important is Nvidia for this global stock market?
I think it's going to be very important, Tom, just given the size and the sheer weight of Nvidia in the S&P 500, Nvidia within the Magnificent Seven. The buzz around AI, its long-term implications, as well as the short-term implications. So the market is waiting on, it's on tenterhooks in terms of how these results actually play out. If we do see a beat transpire again in NVIDIA's results, I think that's going to set off some very positive momentum for the tech space, which could offset, some of that risk that you mentioned of whether we get a downplay in interest rate expectations from 2 to 1. It could offset some of that negativity. and provide that positive momentum to the Mag 7, and hence further spur that equity market rally that we are seeing in the US play out this year.
Okay.